Warren Buffett, one of the world's most renowned and successful investors, is known for his unique and pragmatic approach to investing. As the chairman and CEO of Berkshire Hathaway, Buffett has built his fortune over decades by following solid and consistent investment principles. His strategy values patience, careful analysis, and the pursuit of undervalued assets with durable competitive advantages. At the core of Buffett's investment philosophy is the idea that investing in assets is much more advantageous than keeping money idle. This belief is especially relevant when considering early retirement. In a world where interest rates may be low and inflation can erode the value of money over time, simply leaving money in a bank may not be enough to ensure a comfortable retirement. By investing in assets such as stocks of solid companies, low-cost index funds, or real estate, investors have the opportunity to make their money work for them. These assets offer growth potential and returns over time, helping to build a wealth that can sustain an early retirement. In this context, we will explore Warren Buffett's investment strategies and the best inexpensive assets to buy instead of holding on to money, especially for those seeking early retirement. By following Buffett's footsteps and investing wisely, investors can be better prepared to achieve their long-term financial goals. Warren Buffett's investment principles. Warren Buffett is widely recognized not only for his incredible wealth, but also for his consistent and long-term investment approach. His fundamental principles are a beacon for investors of all walks of life, highlighting the importance of a patient mindset and a deep understanding of the business in which one invests. Long-term mindset. Buffett is a staunch advocate of the long-term mindset when it comes to investing. He believes that the true value of an investment reveals itself over time and that investors should be willing to patiently wait for success. In a world where many are seeking quick results, Buffett reminds us of the importance of resisting the temptation of instant gratification and staying focused on the big picture. Investing in companies with durable competitive advantages. A cornerstone of Buffett's investment strategy is the pursuit of companies with durable competitive advantages, meaning companies that have a solid position in their industry and are able to maintain an edge over the competition over time. These companies often have strong brands, high customer loyalty, patented technologies, or lower production costs, which puts them in a favorable position to thrive even in difficult economic times. Avoiding market timing attempts. Buffett is famous for his aversion to market timing attempts. Instead of trying to predict when to buy or sell based on short-term fluctuations, he adopts a buy-and-hold approach, believing that, in the long run, the market will reward patient and disciplined investors. He emphasizes that trying to predict short-term movements is not only unpredictable, but also a distraction from the true goal of investment, maximizing returns over time. By following these solid investment principles, investors can not only mitigate risk, but also increase their chances of long-term success. By maintaining a long-term mindset, investing in companies with durable competitive advantages, and avoiding attempts to time the market, investors can be better positioned to achieve their financial goals and build a lasting wealth. The best inexpensive assets to buy. By following Warren Buffett's investment principles, it is essential to identify the best assets to buy, especially for those seeking early retirement. Below are some categories of assets that may be particularly attractive to long-term investors. A. Value stocks. Value stocks represent companies whose market value is considered lower than their intrinsic value, based on fundamental metrics such as price-to-earnings ratio, book value, and discounted cash flow. For long-term investors, value stocks offer the opportunity to acquire stakes in undervalued companies that have the potential to appreciate over time. Explanation of the concept. Value stocks are those that are trading below their intrinsic value, meaning their market prices do not fully reflect the true value of the underlying assets of the company. Value investors seek out these opportunities believing that in the long run, the market will recognize the true value of these companies and stock prices will increase to reflect this. Examples of companies. Consolidated companies with low price-to-earnings ratios are often considered value stocks. Examples include companies in the financial sector, such as banks, or manufacturing sector companies that may have been affected by temporary issues but maintain solid fundamentals. Examples may include names like Wells Fargo, General Motors, or IBM. B. Companies with consistent cash flows. Companies that generate consistent cash flows have a significant advantage when it comes to long-term investments. These companies often operate in stable and resilient sectors, allowing them to maintain a steady flow of revenue even in adverse economic conditions. Highlight of importance. Investing in companies with consistent cash flows provides an additional layer of security for long-term investors. Even in times of economic uncertainty, these companies are more likely to continue generating profits, which can provide stable returns over time. Examples of sectors. Sectors such as utilities, public services, which provide essential services such as electricity, water, and gas, tend to have more stable cash flows due to constant demand for their services. Basic consumer goods companies, such as food or hygiene product manufacturers, are also examples of companies with consistent cash flows, as demand for these products tend to be less affected by economic fluctuations. C. Low-cost index funds. Warren Buffett has been a fervent advocate of low-cost index funds as an efficient way to invest in a wide range of companies, providing instant diversification and minimizing costs. Explanation of the approach. Low-cost index funds track the performance of a specific index, such as the S&P 500, and have low management fees compared to actively managed funds. Buffett believes that, for most investors, investing in a diversified index fund is a more effective strategy than trying to pick individual stocks. Benefits. The main benefits of low-cost index funds include instant diversification, which reduces the specific risk of individual stocks, and low management fees, meaning more of the investment return remains in the hands of the investor. Investing in value stocks, companies with consistent cash flows, and low-cost index funds are strategies that reflect Warren Buffett's investment principles, and may be particularly advantageous for investors seeking early retirement. These assets offer a combination of appreciation potential, stability, and cost efficiency, helping investors achieve their long-term financial goals. Final considerations. In this video, we explored Warren Buffett's investment principles and discussed the best assets to buy, especially for those seeking early retirement. To recap, we talked about the importance of adopting a long-term mindset, following Buffett's footsteps and recognizing that the true value of investment reveals itself over time. Investing in companies with durable competitive advantages, seeking out value stocks that are undervalued by the market. Prioritizing companies with consistent cash flows, such as those in the utility sector and basic consumer goods companies, to ensure security and stability over time. Considering low-cost index funds as an efficient way to invest in a wide range of companies, following Buffett's approach to diversification and cost minimization. We encourage subscribers to begin their investment journey, putting into practice the principles discussed and taking the first steps toward achieving their financial goals, especially those related to early retirement. Remember that the investment journey is continuous and requires discipline and patience. By remaining committed to your goals and continually learning about investments, you will be on the right path to achieving financial independence. Thank you for watching this video, and we hope it has been helpful to you. If you enjoyed the content, don't forget to subscribe to our channel to receive more information and share this content with friends and family who may also benefit from this information. Together we can achieve financial success and build a more prosperous future. Until the next video.